Hello students, welcome to RP Education class app. Hope you all are doing good. So let's start about the today's topic, that is pricing for international market and foreign direct investment. Before going into the details of different types of pricing methods, at first let's see the different factors that affecting the prices in international marketing. So there are mainly two types. First is internal factor. Under internal factor, first factor is cost. While fixing the prices of a product, the firm should consider the cost involved in producing the product. This cost includes both the variable cost and fixed cost. Thus, while fixing the prices, the firm must be able to recover both the variable and fixed cost. Next is predetermined objectives. While fixing the prices of a product, the marketer should consider the objectives of the firm. For instance, if the objective of a firm is to increase return on investment, then it may charge a higher price, and if the objective of a firm is to capture a large market share, then it may charge a lower price at initial level. Next is image of the firm. The price of the product may also be determined on the basis of the image of the firm in the market. For instance, AGL, that is Hindustan Unilever, and Procter and Gamble can demand a higher price for their brands as they enjoy goodwill in the market. Likewise, in the electronic sector, the Apple, they always demand a higher price for their brand name. Next is product life cycle. The stage at which the products is in its product life cycle also affects its price. For instance, during the introductory stage, the firm may charge lower price to attract the customers and to grab the market share. And during the growth stage, a firm may increase its price due to its brand name. Next is credit period offered. The pricing of the products is also affected by the credit period offered by the company. Longer credit period, higher may be the price, and shorter the credit period, lower may be the price of the product. Next factor of pricing method is external factor. Under this, first is competition. While fixing the price of a product, the firm needs to study the degree of competition in the market. If there is high competition, the prices may be kept low to effectively face the competition. And if competition is low, the prices may be kept high. Next external factor is consumers. The marketer should consider various consumer factors while fixing the prices. The consumer factors that must be considered includes the price sensitivity of buyer and purchasing power. Next external factor is government control. Government rules and regulations must be considered while fixing the prices. In certain products, government may announce administered prices, and therefore the marketer has to consider such regulation while fixing the prices. Next is economic conditions. The marketer may also have to consider the economic condition prevailing in the market while fixing the prices. At the time of recession, the consumer may have less money to spend, so that marketer may reduce the prices in order to influence the buying decision of the consumers. Next is channel intermediaries. The marketer must consider a number of channel intermediaries and their expectations. The longer of channel intermediaries, the higher would be the prices of the goods. Next topic is quotations. A quotation describes the product, states a prices for it, sets the time of shipment, and specifies the term of sales and terms of payment. Since the foreign buyers may not be familiar with the product, the description of it in an overseas quotation usually must be more detailed than in domestic quotation. The description in quotations should include different points like buyer's name and address, buyer's reference number and date of inquiry, listing of requested products and brief description, price of each item, gross and net shipping weight, total cubic volume and dimensions, trade discounts, delivery point, terms of sales, terms of payments, and different insurance and shipping costs. So next is pro forma invoice. Sellers are often requested to submit a pro forma invoice with or instead of a quotation. Proforma invoices are not for payment purpose but are essentially quotations in an invoice format. Proforma invoices are only models that the buyer uses when applying for an import license or arranging for funds. So this is mainly a model of a real invoice. Next is terms of sale. Terms of sales refer to the conditions and basis of trade transactions. The basic terms of sales are decided in advance between the buyers and sellers as a part of sales contract. In export trade, the pricing decision is very important, which should be clearly settled between the parties of the sales contract. So now I will discuss about the most important types of prices that are often quoted in the international trade. First is loco price. This is the price of the goods are available at the godown of the seller. In the course of shipment, whatever be the expenses, all will have to be borne by the importer. So this is called loco price. Next is on the spot price. This term is used for the price of goods that will be charged for ready delivery of the goods. Next is free on rail. When the responsibility of sending the goods to the railway station and of loading is taken by the seller, it is called FOR or free on rail price. Freight is to be paid by the buyer. Next is free along ship price, that is FAS price. This price includes expenses up to the dispatch of goods to the seaport. This FAS price includes cost of goods, packing, marking, dock charges, and the commission of forwarding agent. Next is free onboard price, that is FOB price. When the seller takes upon himself the responsibility of sending the goods to the seaport and also offloading, it is called FOB price. Next is cost and freight price. This price includes, apart from the above expenses, the freight of the ship also. Insurance premium is not included in this price. Next is cost insurance and freight price, that is CIF. This price includes all the expenses up to the shipment of goods from the port of shipper. The importer has to receive all the delivery of the goods in his country. Next is Franco price. Franco means free from all expenses. Under this price, all the possible expenses in transit are to be borne by the seller, and the seller has to supply goods at the factory of the buyer. Therefore, the expenses in the country of the buyer will have to borne by the seller of the goods. Next topic of today's lecture is transfer pricing. Transfer pricing is arbitrary pricing of exports and imports that may be greater than or less than the arm's length prices. It is basically the pricing of intra-corporate transactions. A transfer price arises for accounting purposes when related parties such as divisions within a company or a company and its subsidiary report their own profits. When these related parties are required to transact with each other, a transfer price is used to determine the cost. Transfer prices generally do not differ much from the market price. If the price does differ, then one of the entities is at disadvantage and would ultimately start buying from the market to get a better price. So, for example, assuming entity A and entity B are two unique segments of company ABC. Entity A builds and sells wheels and entity B assembles and sells bicycles. Entity A may also sell wheels to entity B through an intercompany transaction. If entity A offers entity B a rate lower than market value, entity B will have a lower cost of goods sold and higher earnings than it otherwise would have. However, doing so would also hurt entity A's sales revenue. If, on the other hand, entity A offers entity B a rate higher than the market value, then entity A would have higher sales revenue than it if it sold to an external customer. Entity B would have higher COGS, that is cost of goods sold, and lower profit. In either situation, one entity benefits while the other entity hurt by transfer price that varies from market value. So that regulations enforce an arm's length transaction rule that states that companies must establish pricing based on similar transactions done between unrelated parties. An arm's length transaction refers to a business deal in which buyers and sellers act independently without one party influencing the other. This type of sales assert that both parties act in their own self-interest and are not subjected to pressure from the other party. It is closely monitored within a company's financial reporting. But company go for transfer pricing as it minimize the tax burden or arranging direction of cash flow. Also, it results in shifting profits from one department or company to another of similar business. So next topic of today's lecture is dumping. Dumping is an international price discrimination in which an exporter firm sells a portion of its output in a foreign market at a very low price and the remaining output at a high price in the home market. This is done to turn out the foreign competitors from the domestic market. When the product is sold at a price lower than the cost of production in the domestic market, it is called reverse dumping. So there are several types of dumping. First is sporadic or intermittent dumping. It is adapted under exceptional or unforeseen circumstances when the domestic production of the commodity is more than the target or there are unsold stocks of the commodity even after sales. In such a situation, the producer sells the unsold stocks at a low price in the foreign market without reducing the domestic price. Next is persistent dumping. When a monopolist continuously sells a portion of his commodity at a high price in the domestic market and the remaining output at a lower price in the foreign market, it is called persistent dumping. This is possible only if the domestic demand for that commodity is less elastic and the foreign demand is highly elastic. When costs fall continuously along with increasing production, the producer does not lower the price of the product more in the domestic market because the home demand is less elastic. However, he keeps low price in the foreign market because the demand is highly elastic in the foreign market. Next is predatory dumping. Predatory dumping is one of which a monopolist firm sells its commodity at a very low price or at a loss in the foreign market in order to drive out some competitors. But when the competition ends, it raises the price of the commodity in the foreign market. Thus, the firm covers loss if the demand in the foreign market is less elastic, its profit may be more. There are also different policies to stop dumping. First one is tariff duty. To stop dumping, the importing country imposes tariff on the dumped commodity consequently. The price of the importing commodity increases and the fear of dumping ends. But it is necessary that the rate of duty on imports should be equal to the difference between the domestic price of the commodity and the price of dumped commodity. Next is import quota. Import quota is another measure to stop dumping under which a commodity of a specific volume or value is allowed to be imported into the country. For this purpose, it includes the imposition of a duty along with fixing quota and providing a limited amount of foreign exchange to the importers. Next is import embargo. Import embargo is an important retaliatory measure against dumping. According to this, the imports of certain or all types of goods from the dumping country are banned. Next is voluntary export restraint. To restrict dumping, developed countries enter into bilateral agreement with other countries from which they fear dumping of commodities. These agreements ban the export of specified commodities so that the exporting country may not dump its commodities in other country. Next topic of today's lecture is price escalation. Price escalation is a disparity in pricing where goods have higher cost in the foreign markets than in the domestic market due to transportation and exporting cost. Price escalation can also refer to the sum of cost factors in the distribution channel which add up to a higher final cost for a product in the foreign market. Price escalation is happened due to several reasons such as cost of exporting, taxes, tariffs and administrative cost, inflation in the market, middleman and transportation cost, exchange rate fluctuations and varying currency values. So last but not the least topic of today's lecture is foreign direct investment. Foreign direct investment is an investment made by a firm or individual in one country into business interest located in another country. Generally, FDI takes place when an investor establishes foreign business operations or acquires foreign business assets, including establishing ownership or controlling interest in a foreign company. Foreign direct investments are commonly categorized into three terms. First is horizontal direct investment, which refers to the investor establishing the same type of business operation in a foreign country as it operates in its home country. For example, a cell phone provider based in the United States opening stores in India. So, this is called horizontal direct investment. Next is vertical investment. This is one in which different but related business activities from the investor's main business are established or acquired in the foreign country, such as when a manufacturing company acquires an interest in a foreign company that supplies parts or raw materials required for that manufacturing company to make its products. So that type of investment is called vertical investment. Next is conglomerate type of foreign direct investment. This is one where company or individual makes a foreign investment in a business that is unrelated to its existing business in its home country. Since this type of investment involves entering an industry in which the investor has no previous experience, it often takes the form of joint venture with a foreign company already operating in that industry. So, to know more about different advantages and disadvantages of foreign direct investment and the investment limits on different companies in India, kindly follow the RP education notes on page number 22. These percentages of FDI limits in various sectors in India is very important for the exam. So, remember these limits. So, students, this is all about the today's topic that I want to discuss through this video about pricing method of international business and foreign direct investment. If you have any doubt or queries, let me know by comment here or on WhatsApp group. RP Education is always with you. So stay tuned with us. See you in the next video. Thank you.